A pleasant morning to you all. My name is Samantha Ngwenya. I'm going to take you for financial accounting and flow. And basically today we are going to look at a topic called cash flow statement. What I will do, last time on our previous lecture, we actually did notes in the preparation of a cash flow statement where we managed to calculate cash received from debtors and cash paid to our suppliers. Hoping that we have got those two figures, because we are going to use them as we proceed with our cash flow statement. I won't read the whole question for the sake of time. What I'll do, I'll go straight to the additional information, then we'll prepare our cash flow statement. For you to prepare a cash flow statement, you need to have two statements, which is the income statement. I've provided it here, as well as the balance sheet and the notes, as well as the additional information. Additional information, it reads during the current financial year, the following transaction took place. Equipment cost 12,000 was sold for cash. The accumulated depreciation written off was 8,500. Number two, a delivery van cost price 30,000 was sold on 28 February 2015 for 18,000 cash. A delivery van purchased for 50,000. Point number four, the proprietor increased drawings by 70,000. Okay, I'll use this small board of mine to do my calculations and the preparation of the cash flow statement. Okay. The subtopics, you should say Mthatha cash flow statement for the year ended 28 February 2015. Your cash generated, you start by cash generated from operating activities. Then for cash received from your clients, you got this figure from our previous lecture, which was equivalent to 953,320, and cash paid to our suppliers, which was 579,920. Then you subtract these two figures, you get your cash generated from operation, which is 373,400. Then you proceed on to your interest paid. Your interest paid, you get it from your what? From your income statement here. Under your what? Under your expenses. There it is. Interest on loan 16,000. You take it there, interest paid 16,000. Then your interest received, you get it under your what? Your income statement as well. Under the other what? Other incomes. You discover that your interest on fixed deposit, it was 7,320, while your interest income was 508. So you add these two to arrive to this figure, which is equivalent to 12,900. Then you list your drawings. Your drawings, I got them under your additional information number 4, which says the proprietor increased the drawings by 70,000. It has to be subtracted. Whatever is in the brackets, it has to go to be subtracted. If you say 373,400 less 16,000 for your interest paid, then you add this one. You don't subtract this, you add this one, because it was interest what? Interest received, which is interest what? Income, plus 12,900. You less your drawings for 17,000. You discover that you get your cash generated from operation for 3,300,000. Then you are done with the first one, the first part for cash generated from operations. This is to be positive as well. Because if you say this 373,400 is positive, you less only 70,000 and 16,000, you add 12,900. Then you proceed to cash generated from investing activities. The cash generated from investing activities, here basically we are dealing with the sale and purchase of fixed assets. Under this question from Mthatha Limited, we've got 3 types of fixed assets. We've got buildings, equipment, and as well as what? Motor vehicle. Are we together? So for the additions, I'll be referring to the purchase of fixed assets. How much money was taken from the business to purchase a certain fixed asset? How coming into what? Into the business. That's what will be retailing in this story under investing activities. Are we together? We'll start by what? Buildings. We'll discover that the buildings for 2015 there were 880, but for 2015 we increased that the buildings have increased for 1,080,000. It means that Mthatha dealers actually bought new buildings during this particular year. So you just have to what? To separate. Just have to separate 10. 1,008 minus 880, you will discover that it will give you 200,000. It means that Mthatha Motor Dealers actually purchased new buildings worth 200,000, because from your notes it shows that the building figure is actually increased. I placed this 200,000 into bracket to show that it was what? A purchase. Then you proceed on to the other type of what? Fixed assets, which is what? Equipment in this case. Under equipment, we'll discover that equipment at the beginning of the year it was 190, but at the end of the year it was how much? 203. Meaning that there was equipment bought there. And under additional information, you discover that you are told that equipment cost 12,000 was sold for cash. The accumulated depreciation written off was 8,500. I would like to solve this one using what we know as what? A T account. You say equipment. Say balance BD, which is equipment at the beginning was worth 190,000. Then balance CD, it was 203,000. Then you disposed. Disposal, equipment cost how much? 12,000. How much was bought? If you say 203 plus 12, you get 215,000 minus 190, say additions, equivalent to 25,000. You go to your cash flow from investing activities, you say additions to equipment 25,000, which you got in the calculation using a what? A T account. Let's calculate the proceeds from equipment. Proceeds which equal to, under additional information, we are told that equipment worth 12,000 and the accumulated depreciation for 8,000 what? 500. If you say 12 minus 8.5, you discover that the gross amount for equipment it was worth 3,500. Are we into agreement with this one, with this figure? But under your income statement, we are also told that profit on sale of equipment was worth 3,500 as well. Profit on sale. Profit on sale was worth 3,500 as well. Meaning that Mthatha dealers actually sold a piece of equipment worth 3,500 and it sold this equipment at a profit of 3,500. How much did they receive in full? Meaning that they received 7,000, which you get by adding 3,500 plus 3,500, which is equal to 7,000. You come and put it under your what? Your additional information, and you say proceed on sale of equipment 7,000. This one I won't put it in brackets because the cash is actually coming into the business. Mthatha is actually selling its equipment and receiving what? Cash. Then you go on to another fixed asset, which is motor vehicle. Motor vehicle, the point is clear there under additional information, note number 2. They say a delivery van cost 30,000 was sold on 28 February 2015 for 18,000. Meaning that addition for motor vehicle, these were the proceeds. Proceeds for motor vehicle is 18,000. Then on point number 3, A delivery van purchased for 50,000, meaning that Mthatha purchased a motor vehicle worth how much? 50,000. Then you put it in what? Bracket. Then, if you read very well, under your non-current assets, we've got other financial assets. For 2015, the figure was 40,000, but for 2014, sorry, the figure was 40,000, but for 2015, the figure actually increased from how much? From 40,000 to 60,000. What does that mean? It means that the company has actually bought new one or invested somewhere. It's money, meaning that the money was actually coming out of the business, being invested somewhere. The money which was worth how much? 20,000, subtracting your 60,000 and your what? Your 20,000 as well. It has to be what? In brackets. If you add all these figures, 200,000, negative 200,000, negative 25,000, positive 7,000, negative 50,000, positive 18,000, and negative 20,000, you discover that you get a negative 270,000. A negative figure in cash flow statement indicates that it's actually a cash what? A cash outflow. We are done with cash flow from investing activities. Then you proceed on to cash flow from financing activities. Cash flow from financing activities. Are we done? Under cash flow from financing activities, we'll discover that you check these ones under your non-current liabilities. You discover that we had a loan which was worth, so we say repayment of loan. We discover that you have got a loan which had an interest of 14% per annum. The loan in 2014 it was worth 600. 2015 it was worth 620,000, but this was 2014. But you discover that in 2015 the loan was worth how much? 600,000. Meaning that the business has actually paid 20,000 because their liability at the beginning it was worth 620,000. But by the end of 2015 they discovered that the loan is now reduced to 600,000, meaning that they paid a loan for 20,000. Cash outflow from financing. It was worth how many? 20,000. We are done. Then now you deduce whether was it a net what? A net increase in cash or a net decrease in cash by starting from cash flow from operating activity. Cash flow generating from operating activity, it was 3,300,000. We are done. Then from investing activity, it was a cash outflow of 270,000. So we say less 270,000. We are done. Then cash flow from financing activity, it was worth how much? 20,000, a cash outflow. So you less your 20,000 as well. You discover that you have got a net increase in cash equivalents for 103 for 10,300 for 10,300. Then you add cash at the beginning. Cash at the beginning. This one you get it under your note number 3, which say cash and cash equivalent. We discover that your bank balance for 2014 it was 10,900, while for 2015 it was worth 21,000. 21,200. So your bank balance at the beginning, it was what? 10,900. You say 10,300 plus 10,900. You discover that you need to get your cash at the end, which is 21,200. Cash at the end. For you to deduce that your cash flow has actually balanced, you have to what? To compare it with your what? With your bank balance at the beginning and at the end. This 21,200, you will discover that on note number 3, it will be your bank balance at the end for what? For 2015. Thank you very much. See you next time when we are looking at another question for cash flow statement. Thank you.